It's a pleasure and privilege to be with you here. And as Ruth said, I've actually been working on this book about 1929, but the truth was I was never really expecting or intending it to be about today. We're going to talk about whether, though, it is about today. At least I think as we've gotten closer to today, things have started to converge in ways that I didn't expect. I thought of it as a prequel to Too Big to Fail, so I didn't have to write a sequel, but I'm getting nervous that a sequel is coming. I am here with two people who need no introduction and know more about where our economy is going. Hopefully, we'll see. There is no stock advice, and we don't have any. You're not going to be on the hook for what you actually say in case people are going to be buying or selling things, but that's not what we're really going to talk about. What I wanted to ask you, this is where I want to start this whole conversation. The great investor Paul Tudor Jones, literally just yesterday, said that he believed that we, our economy, and the markets are in October of 1999. Now, in October of 1999, people may remember or not remember, the stock market still had 40% to go up on the upside. But you had to know when to jump off the train. And so the question is, if you believe that we are in 1999, if we're in 1998, if we're in 1996, what are we?
We are in a completely new world. Completely new world. On the surface, we're in a new world because we've thrown everything at the US economy. We've thrown tariffs, we've thrown all sorts of things, and it is incredibly resilient. Growth is keeping up, inflation is contained, the markets are booming. Look beyond, and we're starting to see things we didn't see in 1999. We're seeing this very strange coincidence of risk-on assets, stocks, and risk-off assets, gold, at new highs together. We've never seen that. We're seeing the US starting to perform like a developing country. Take ownership in companies. We had the fifth announcement today. We're starting to see the dollar languish. And even though people are in love with US private sector, they worry about the US public sector. As my daughter puts it, go long US enterprise, short the mess. And what we're seeing is people are investing in the US but hedging. I'm saying all that because we're seeing the sorts of behaviors that we haven't seen before, and that's why it's very difficult to make a historical comparison. And fundamentally why? Because of what we've heard in this incredible gathering. We are rewiring the global economy, both in terms of AI, but also in terms of what the US is doing. The US is trying not just to rewire the domestic economy, it's trying to rewire the global economy. So that's why I find it really hard to make a historical comparison. I am uncomfortable about quite a few things, and I'm incredibly excited about lots of things.
But I worry that we always, the problem is just when things are about to go off the cliff, everyone says this time is different. Is this time really different?
I think this time is different because of what Ruth said, because of what Sundar said. We have a general purpose technology, we have proof of concept, and we are just starting to diffuse it through the economy. And if we get diffusion right, and that will depend on a lot of you, understanding that this is not a labor displacement, this is not about cost efficiencies, this is about enabling the people who work for you to do new things and incredible things. If we get that right, this time will be really different because we will get the productivity increases that allow the awful legacy that I'm leaving for my kids, low growth, high inequality, high debt. If we get the productivity increase, and Mike can speak to that so much better than me, we can fundamentally change all the bad things that I have.
Okay, well, Michael, let me just ask you, and I'm sorry to be the skeptic here. Look, I'm very excited about AI. I think it's going to change the world. And we might be in some kind of gold rush, and we might be having a sugar rush at the same time. What I'm trying to figure out is if you get all these productivity gains, productivity is oftentimes a euphemism for the word layoffs. It also means unemployment. That's the only way to actually make things demonstrably more productive, at least in the short term. So what does that look like to you?
So it looks turbulent in the short run, with the diffusion process that Mohamed just adverted to. which is the only way to get productivity. I mean, if we get productivity surges in tech and finance and everybody else is still sleeping, we're not going to see a productivity surge and it won't make that much of a difference. So that's a preoccupation of ours and many people at Google and in James's AI and Economy section. But I'd like to back up. I mean, the way I see the global economy, and not just the American economy, is we are accumulating headwinds that became obvious as we came out of the pandemic. You know, we've got aging, declining workforces, declining productivity trends, high dependency ratios for the young people who are still working and keeping me, the oldest person in the room, you know, going, et cetera. And if you sort of array that all and ask, what is the one thing you would really want to have, you know, to deal with debt overhangs, to deal with declining? The answer is productivity increases and real growth. So I think the yin and the yang of this, Andrew, is it's a pretty grim-looking situation out there without the upside potential of this. You have a global economy that is subject to shocks. You have a global economy that is riven by geopolitical tensions that won't go away because we don't trust each other. You have a completely different architecture, right? We lived for 70 years after World War II because a bunch of very smart Americans said, we're not going to do the things we did in the past, and we'll create an open global economy. I mean, it's just stunningly brilliant results. That's not the architecture anymore. The dominant force in economic international policy is now security, resilience, right, and so on. And so I just, as a backdrop to the focus on this, which I agree with both of you and everybody else who's spoken here, it's kind of urgent that we get this right.
Okay, so let me just ask you this, and then I want to get to tariffs and everything else that's going on, because I think we're all trying to understand where this is all headed. But on the AI front, and I think we can all be very excited about it and want this to, and it may be the thing that saves us in the end. What I can't figure out is in this moment, right now, it looks like our economy is doing quite well. What I can't figure out is whether the massive investment in AI is masking, effectively, some much larger imbalances underneath it, meaning, and how sustainable this is. So one of the things that's happened, so many of you have been commenting on to me even in the past day and a half, is this idea that, you see NVIDIA, take a stake effectively in OpenAI, you have OpenAI turn around and do this sort of interesting deal with warrants with AMD, and they all look like circular deals. Like people are basically just giving it's one piece of money going from one pocket to another, in some cases even making up money in the process. And how sustainable, I mean, when I go back and look, by the way, at 1929, or by the way, go back and look at the late 90s, this leverage piece and this idea of these kind of circular vendor financing deals is what they call them, get people very anxious and typically are not sustainable.
So, you hear me?
You go ahead.
No, go.
So I think there's two parts to this. I mean, there are elements of what's going on in the financial sector that I'm going to leave to you and Mohamed, because you know more, that feel more like the run-up to 2007, 2008, to the GFC. Opaque instruments, things going around in circles and so on. But if you go back to the internet crisis, I think this really does feel somewhat different in the sense that I was the dean of the business school at Stanford, at the height of I had the good grace to step down before it crashed. It was one of my best decisions. And my successor did not thank me. And the ratio of real companies that were being created then, like this one, to things that were never going to succeed, never had revenues, never had profits or anything else, was fairly low. These are important companies, but there were tons of the other things. And there was, a kind of massacre in the VC world coming out of that. I don't have any doubt that there's incentives to overinvest because of the cost of not being at the forefront for the major players that are doing this. And I wouldn't be very surprised if there's some excess valuation that goes with this. And as Sundar frequently says, and in addition, there's a tendency to overestimate the impact of a revolutionary technology in the short run and then underestimate it in the long run. So all of those things put together suggest that for investors, you need to be careful in this environment. Mohamed, over to you.
Yeah, I say most of us would act no differently. We would throw money at this, one for behavioral reason and another one for the upside. On the behavioral reasons, history shows that whenever you get a major innovation that reduces the barriers to new activities and existing activities, two things happen. We as humans overconsume and overproduce it. Every single innovation has happened that way. So there's a behavioral aspect that leads to the exuberance that Sundar spoke about. But then there's something else that we haven't seen before, and that's what Mike just referred to, is that it's rational for every actor in this to invest as much as they can because the payoff is so huge. So you will get excess investment. You will get rational exuberance. There will be tears. There will absolutely be tears. But in the process, you're going to enable something that is going to be fundamentally transformational. And if you start looking at health, as we did this morning with Ruth, education, if you go sector by sector and look at what is being enabled, the minute that starts adding up, so what we heard about health today is AI, life sciences. Robotics are coming along. Further down the road is quantum. When all these things comes together, it's fundamentally transformational, Andrew.
Let me ask,
Andrew, can
yes.
I add one other? Is
Please.
this kind of the folks who don't live in advanced economies? And Ruth did reference this in the healthcare area. You know, that the scans that early diagnose diabetic retinopathy are important everywhere, but they're massively important in India, where this is an endemic problem. And literally millions of people will not go blind because of this. You can do the same thing with skin cancers. But the one I wanted to mention, because it's the world that both of you live in a lot, there is a global explosion of the use of AI to deliver credit to people who are otherwise completely out of the system, anonymous, right? No collateral, no track record, no nothing. And the digital economy is just transforming the opportunity set for them. So in that dimension, it's really exciting.
Okay, let me ask you a completely different question, which was both of you referenced this idea that the entire global economy is shifting under our feet, namely around tariffs and the combination of the more general idea of national security. And sustainability, we can discuss all of that to some degree. My question to you, it's maybe a political question before we even get into the tariffs themselves. Do you see this as a permanent state? Or do you say to yourself, you know what, in 2.5, 3 years from now, if there's a different president in office, or maybe in 7 years from now, if there's a different president or a different political leader in office who says, I don't like tariffs, we're not doing it this way anymore? Or do you think this is what's just happened over the last basically 6 months is now our reality for the next generation?
If you define the next generation as the next 10 years, I have no doubt in my mind that this is permanent. No doubt whatsoever. The geopolitics, you heard Condi say yesterday that if anybody thinks that there will be a reduction in tensions between the US and China, it's not going to happen. You're talking about two major economies. When economics was in charge and politics and national security were sitting in the back seat and economics was driving the car, it looked really good. We had two unifying concepts. One was called the Washington Consensus, that countries should deregulate, liberalize trade, be fiscally responsible. And one was globalization. The more we linked the world, the more efficient it was. We forgot about distribution. We forgot that in the process, we may end up alienating a lot of people. And when people get alienated, they get angry. And when they get angry, they become one-issue voters. And you get a change, and that change is with us for a while, because a lot of people out there say this is what we needed. But hold on, let me just say something. We've gone through this before. We went through it under Ronald Reagan and Margaret Thatcher. They tried to rewire the economy in response to what did not work. And it was really painful in the process, but we came out, both the UK and the US, with a more efficient economy. This time, we're trying to do this on steroids. the Trump administration is trying not just to rewire the domestic economy, it's trying to rewire the global economy. So this is a massive experiment with much higher risk that could lead to something good or could lead to stagnation.
Well, that's where I was going to go. So Michael, I guess the bigger question is this going to work? With the context being, by the way, in 1930, we implemented the Smoot-Hawley tariffs. Within 12 months of those tariffs taking effect, global trade had dropped by 60%. That's the math. And so the question is, we're all looking around going, oh, it's all great. I can't figure out, is it all great? Is it because this whole AI boom is, as I said, sort of papering over everything else? What's happening?
No. First of all, it's not all great, right? If we trusted each other and we weren't insecure, we didn't have single points of failure like ASML, or TSMC in Taiwan, then we could keep the old system and it was more efficient, right? It produced more static efficiency and dynamic progress. But that's not the world we live in, and I agree with Mohamed. It's not just the China-US tensions, it's shocks, right? I mean, people will probably remember the automobile industry came to a screeching halt after the tsunami in Japan because there was a single little part that got swamped by that wave. That's just not going to happen anymore. I mean, and so both policy and corporate decision-making, to secure their supply chains is just pushing us away from that. But there's a price to pay. The short-run price is dramatically reduced growth, and you can see it all over the world because you don't make big structural changes without any cost. But even in the long run, I mean, when I'm teaching about this, the students kind of look at me and I say, look, if you're trying to minimize costs, you minimize costs. If you have another objective, and you're not minimizing the costs, you're not going to minimize them.
Okay, let me throw one other cost potential at you, though.
Okay.
I spent some time about a week ago with the CEO of one of the large American automobile manufacturers. There are not many, so you can make a guess about who this is. And this person said, in 10 years from now, if we're having this conversation in 10 years, the truth is, and this person said they did not want to say this on the record, so I'm sort of sharing this with you this way. In 10 years from now, Americans will pay more for bad cars than they ever did before. And that the truth is that you will go to Europe and you'll go to Asia and you'll go to other parts of the world and you'll see people driving around in better cars that cost a lot less. And how are we going to feel about that then? Do you believe that's what's going to happen?
No.
You don't?
No. I mean, so this is the difference between sort of 0-1 choices and something in the middle, right? So the fact that the global economy is undergoing a process that many people refer to as partial de-globalization does not mean that trade is going to stop. It would take an insane set of policies to try to reshore everything in America. I mean, it just doesn't make any sense. Vietnam produces a significant fraction in the textiles, apparel, and footwear device. I mean, it would be enormously costly to bring that kind of stuff back home. So I am less, cataclysmic in the view of how this is going to go. But I think we should be realistic that, it's going to be expensive. The other thing we talked about before, and I'll just mention it briefly, is it's going to hurt small economies more if trade fails. Because a big economy like the United States or China can afford to have a full portfolio of industries, service and manufacturing, without paying a huge price in terms of scale economies, learning curves, and other things. But even a relatively rich, dynamic, small economy like Sweden can't. It has to specialize, and the only way to thrive in a world of specialization is trade. So they're more vulnerable.
Let me add a couple of things, if I may. This is not the 30s because other countries haven't retaliated against us. And that's the big surprise. Now, there are some outstanding ones. We don't know what China's going to do. We don't know what India's going to do. But Europe folded immediately. The UK folded immediately. And somehow, other countries thought it's better for us to give the US what it wants than get in a fight. That's a big surprise. That's a big difference. I think the thing we're struggling with is that we are used to what's called a Bell distribution, a normal distribution. There's a very high likelihood of an outcome and very thin good tails and bad tails. That's not the distribution we're living in. We live in a distribution where the middle comes all the way down, and the two tails, good and bad, are higher. So you hear us talk excited here, scared over here. So what do we need? What do you all need to navigate this really uncomfortable distribution? Because you're looking one way, you're looking the other one. You need what he said first, resilience. The likelihood of making a mistake in this world is high. We are in such a different world that you need to be able to bounce back, and that's about financial resilience and human resilience.
Okay, I have a philosophical question for you, though.
Right. I didn't give them the other two things they need.
Give them the other two.
The other one is agility. You need to think differently. You need to have cognitive diversity, because if you're stuck in groupthink, you will fail. And the third one is, the second one is the open-mindedness, what we call optionality, and the third one is agility, the ability to move quickly.
Okay, here's my philosophical/practical question. The other thing that we see in the headlines constantly is that the United States, typically known for being this capitalistic bastion, free market place, is now taking stakes in companies as if we are China or Russia. And my question to you is whether you think long-term that is going to have any impact whatsoever. So far, by the way, the stock market, nobody seems to care. Everyone seems to think this is all good and fine. I don't know if that's true. Is it?
So I'm nervous. I'm nervous because it's going beyond national security. I'm nervous because I don't believe this administration will simply focus on ownership. It will go over the line that says control. And I'm also nervous because this is leading other countries to do two things. One is go back to the image they saw of the presidents of China, Russia, and the Prime Minister of India, and we talked about this yesterday. Tell the rest of the world, trust us. We are now the custodian. We will not do what the US is doing. And they're starting to think, has the US really lost its leadership role? Is it no longer a responsible custodian? And then the second question I get asked is, so Russia has lived outside the dollar system and survived. How did that happen? So the more we go into things that we used to say are bad, the more the rest of the world is going to react by thinking, maybe the US no longer is a responsible custodian of the global order. And that is a real problem for us.
I agree with that. I mean, I live in Europe and I grew up in Canada, and they both decided we're an unreliable and unpredictable ally, whether it's defense or anything else. So that part's right. But to go back, there's a little bit of we're behaving like developing countries. We must be making a mistake. I've spent a lot of time in developing countries, trying to both understand and help them. And the answer to the question, is it a mistake, depends entirely on the details, right? So the test for whether a government investment is a good idea depends mainly on whether it is displacing the private sector or doing something complementary to it that enables it to do more, right? And you can find lots of examples of both things. But there are lots of areas, especially in developing countries, because they're missing institutional capabilities and so on, where the government does something that unlocks rather than the reverse. So I use that test on these cases. Does the United States government owning 10% of Intel, does that actually make a difference? If we want a healthy domestically based company, I don't have a good answer to that, but it's. I'd really rather not people walked out of the room and said, geez, if they're behaving like developing countries, there must be something wrong.
Let me ask you a different question. One of the other big headlines that I think people have been grappling with recently is this idea of the independence of the Federal Reserve.
Yep.
And how independent is it? How independent has it actually been historically? Meaning, has it actually been independent? And what happens as a result? And so, you hear about Lisa Cook, you hear about Jay Powell, who's going to be out of this job in May, and the president will have a new person in that role. When you look at this, are you surprised? Because there were a lot of people with their hair on fire who said, and by the way, including myself at one point, that said, if there's no independent Fed, the markets are going to take it out on them, right? And that has not happened. Why do you think that is?
So let me just first start with an independent central bank, which means that the government, in case this Congress, sets its objectives, and then the central bank is left to choose how it will achieve those objectives. That notion of independence, which is called tool autonomy, is absolutely crucial to our well-being. And we've learned this over and over again around the world. So that's the first one. The reason why the markets haven't reacted is because the markets do not fundamentally believe that we will lose the independence. What is going on right now may be a good thing, because an independent central bank doesn't mean an unaccountable central bank. It doesn't mean a central bank that is stuck in groupthink. It doesn't mean a central bank that doesn't modernize. And the Fed, being independent and being so protected, has made mistake after mistake. It hasn't, like other central banks, owned their mistakes. It doesn't have external members that bring a different perspective into the discussions, and therefore it gets stuck in groupthink. And what I find encouraging, Andrew, is what's happening. In the last 2 weeks, 4 senior officials of the Fed have come out and said, we need to do this differently. We need to do this differently. So the one upside of this is that the issue of reforming certain things within the Fed is now being discussed inside the Fed. The awful side of this is that it could go too far on the politics side. But we have to understand, this Fed has failed, but it hasn't been held accountable.
Well, okay, I think there's a debate, though, about whether you think it's failed. I'm not so sure. I think it's...
We have been above the inflation target for 5 years. We will be, according to Fed estimates, above it for another 2 years. That's 7 years where they haven't met their objective. We've had banking crisis under their nose. You've reported on what happened in California. And it is late in cutting interest rates. You know, I don't think anybody would give this Fed an A+.
But I think there's a distinction, and Michael, I want to get your view on this. I think whatever mistake they've made has not been influenced by politics.
No.
You may disagree with that.
No, I don't. It's been influenced by incompetence. Why? Because they're not open to the outside world. What independence...
So you think that the political pressure can actually be a good thing, is what I think you're suggesting.
I can, if it doesn't go too far.
Okay, Michael, go ahead.
No, I think I always defer to Mohamed on this, because that's where he spends his intellectual life and understands it better. But I think if you look at the Fed, there's 2 possibilities here. One is that Trump is trying to force a regime that economists call fiscal dominance, which is we set the program and it's the Federal Reserve's job to make it affordable. And that usually means lower interest rates than are ideal. The other one is which is more benign, is there's a legitimate disagreement in a very complex economic environment that's hard for everybody to navigate, whether they're in business or government or the central bank. Mohamed described it very well at the start. And so a more benign version of this is the Trump administration thinks there's a legitimate reason to get the interest rates down because there's some weakening in parts of the economy, and the Fed is being stubborn. And I will say, the Fed, I'm a little bit on Mohamed's side on this, that the Fed, because it talks mostly to itself, and we know from lots of case studies that, that when a company talks to itself and doesn't have input from the outside, usually it gets lost somewhere, like the old IBM case, for example. The Fed didn't respond very well, from my point of view anyway, to a world that looked like it was changing structurally, where their cyclical models weren't predicting very well.
I just want to make 2 quick points. One about actually going back to 1929 and the politics of the independence of the Fed, because I don't know if people will fully appreciate. One of the reasons the Fed did not step in that moment to try to fix things was because they were such a new institution they'd just been created in 1913, that they were worried about the politics. They were worried that actually if they tried to slow down all of the speculation, and they did it and made a mistake, that they would be not just blamed and lose their job, but they actually thought the Fed would disappear, like it wouldn't exist again.
Right.
Here's the big question I want to ask you, because we sort of started talking about a bubble at the beginning. To me, every financial crisis is a function of one thing, leverage, too much leverage in the system. And the one piece of this that I don't think we talk enough about is leverage in the system today has moved. It's shifted. It's not on the balance sheet of banks the way it used to be. It's actually hidden in the context of what's called private credit. And that the private credit, even though it's off the balance sheet of banks, is actually conjoined. It's connected still to the banks, but the banks don't actually have control of what's going on because they're the ones that provide effectively liquidity to them and what happens in that moment. And so I'm curious how you think about that now. Because at some point, whether Paul Tudor Jones is right about it being October or you're right about it, whatever it is, at some point the rubber will meet the road and we'll feel something.
So first, the fact that the risk has shifted from the banking system to non-banks is consequential because the banking system is in the middle of the payments system. If two banks don't trust each other, which is what we saw in 2008 after the Lehman collapse, the whole system comes to a stop. It's called a sudden stop because nothing happens on there.
Right.
This time, we're looking at it differently. That's the good news. The bad news is crises don't happen quite, rationally. What tends to happen is suddenly there's a change in sentiment. And when that change in sentiment happens, then you get herd behavior, and no matter how protected you think you are, you will be impacted. So I worry like you that there's excesses, but remember, AI is playing a critical role. 60% of the growth in this economy comes from AI. AI has made people wealthier, they're spending more. AI has literally pulled up the shares of other companies. So we are anchored in something that's not as fluffy as 2008, as fluffy as 2002, but we do have excesses, that's absolutely right. And we'd be fooling ourselves to think that if suddenly sentiment turns, look what's happening in Europe. Sentiment has turned against France in the bond market. Now France is viewed as a bigger risk than Italy. Italy is a peripheral economy. Italy was one of the so-called pigs, Portugal, Italy, Greece, and Spain, and France was viewed as the responsible, no more. France now, the French government has to pay more to borrow than the Italian government. So if sentiment changes, this notion that, we've separated, everything is fine, will come under stress.
I knew he'd bring up Italy. I live there. Could I just,
Please.
Very briefly, when I listen to people outside worry about this issue, the first thing you hear about is whether or not the dollar is as convertible as it used to be, and whether the United States is a good place to invest. And there's some capital flows that suggest there's some concerns about that, and it's not just Russia. Second, the United States public debt has benefited enormously from inflows from abroad. So if you disrupt that by changing their confidence, then you've got a potential problem. And the third is everybody I know who's looked at the trajectory of public sector debt in the United States thinks that you can't do it forever. That doesn't mean we know when it's going to break. And so those pieces of the puzzle are kind of in addition to whether we have some huge transparency opaque problem that is going to spring on us.
We do need to hand it off. I want to thank both of these gentlemen for a fabulous, fabulous conversation. Thank you so very, very much.